Hey everyone, welcome back to Finance Flicks Hub, where we help you make smarter investing decisions and break down the markets without the Wall Street fluff. This past week felt like a total roller coaster, a classic case of good news getting steamrolled by panic headlines. Tech earnings kicked things off with a bang. But then, just as investors were starting to breathe easy, things took a sharp turn south. It was the kind of market moment where Warren Buffett's timeless advice hits home: when it rains gold, don't bring a thimble, bring a bucket. In this video, we're gonna dive deep into that idea, and why this pullback in tech might just be the opportunity of the year. We'll break down what happened in the market this week, take a close look at Amazon, Microsoft, and Apple, and explain why their post-earnings dips could be golden chances for long-term investors. Let's jump in. The week started strong. Microsoft crushed earnings, jumping almost 10% on the back of major growth in cloud and AI. But then came the reality check. Amazon and Apple both slid hard after reporting, down 8% and 5%, as investors reacted to slower guidance and competitive pressure, not the actual earnings numbers. Just when tech bulls were catching their breath, a weak July jobs report and rising US-Russia tensions sent the markets tumbling. The Nasdaq dropped 2.2%, and the S&P 500 fell 1.6%, all in one day. Yeah, it was a rough one. But here's the thing, this kind of shakeout can actually open the door for those with the long-term mindset. Especially when we're talking about top-tier tech companies that just got cheaper. Let's start with Amazon, a great example of how market reactions don't always match the fundamentals. Amazon delivered strong Q2 numbers. But the stock still slid 8%, mostly because AWS, Amazon's cloud business, didn't grow as fast as Microsoft's or Google's. But let's get real, that's not falling behind, that's leading the industry. Right now, Amazon controls about 30% of the global cloud market, serving big league clients like PepsiCo and Warner Bros. Discovery. AWS is now on pace to hit $125 billion in yearly revenue, and it could crank out $50 billion in profit next year. And AWS isn't the only engine humming. Amazon's e-commerce and ad businesses are also speeding up. Total company revenue climbed 13% year-over-year, hitting $167.7 billion, which beat expectations. Advertising is becoming a secret weapon, driven by Amazon's huge customer data and expanding streaming platform. Looking forward, the US cloud market is expected to grow 7x by 2034, hitting $3 trillion. Amazon's positioned right at the center of that wave, especially with its push into generative AI tools, enterprise-grade AI services, and custom-built infrastructure. Bottom line? Amazon's recent drop looks way more like a buy-the-dip moment than a warning sign. Now let's talk Microsoft, a company firing on all cylinders. They just posted $76.4 billion in revenue, up 18% year-over-year. Their cloud unit, Azure, grew a solid 26%, and it's now running at $120 billion per year. That puts Microsoft squarely in second place behind AWS, but it's closing the gap fast. And here's what sets Microsoft apart: $25.6 billion in free cash flow in one quarter. They're on track to bring in $100 billion in free cash flow this year. That kind of cash lets them. Microsoft's secret weapon is how tightly integrated its services are. Azure connects with Office 365, Teams, GitHub, LinkedIn, you name it. That ecosystem creates a sticky customer base and opens the door for major cross-selling. And when it comes to AI, Microsoft is all in. They're embedding AI tools across the board, turning Azure into a launchpad for enterprise AI adoption. With the AI boom and cloud spending set to surge over the next decade, Microsoft is sitting in a sweet spot. And in a slower economy, its recurring revenue model makes it a reliable, defensive play. This recent dip? It might be one of the best buying windows we've seen in a while. And now, Apple, the king of consistency. In its latest quarter, Apple pulled off not bad for a company some folks say has already peaked. But the real MVP? Apple's services segment, which includes Apple Pay, iCloud, music, and subscriptions. It's not just growing, it's high margin, and it's quickly becoming a major profit engine. Now, on the AI front, Apple's taking its time. It's already rolled out 20+ AI-powered features, and a much more advanced, personalized Siri is coming in 2026. Some think Apple's late to the party, but don't count them out. Apple's strategy has always been to roll out tech that works seamlessly across its ecosystem. With over 1 billion active devices, even small improvements in AI could lead to huge new revenue streams. Apple expects solid mid to high single-digit growth next quarter. And with the iPhone 17 launch, fresh AI features, and growth in wearables and payments, they're forecasting a return to 9% annual growth by fiscal 2026. Yes, there's risk, like possible tariffs if the political landscape shifts. But Apple's brand loyalty, cash reserves, and user base make it a defensive tech stock that delivers. This pullback? It looks like a classic Buffett-style buy signal. Here's what all this tells us: even though the headlines are loud, the fundamentals are strong. These dips in Microsoft, Amazon, and Apple aren't about failing businesses, they're about short-term fear. And that's exactly when long-term investors should lean in. We're likely heading into a cycle of rate cuts, cooling inflation, and continued growth in AI and cloud tech. These companies are built to last, and now they're trading at discounted prices. Buffett's quote isn't just folksy wisdom, it's a real-world investing strategy. When it rains gold, don't bring a thimble, bring a bucket. Right now, it's raining opportunity. Are you ready to catch it? If you got value out of this breakdown, go ahead and smash that like button, subscribe, and turn on notifications so you don't miss our next investing deep dive. We break down the noise, focus on the data, and help you build long-term wealth with confidence. Thanks for tuning in, and remember, stay focused, stay informed, and above all, stay invested.